With more bricks and mortar retailers in the US closing, including last night, when, as expected, Forever 21, which was at one point the fastest growing US retailer, filed for Chapter 11 bankruptcy. Zero Hedge was reporting about 2 weeks ago that Forever 21 would eventually go bankrupt. They put out an article on Saturday, September 14th, that Forever 21 could go bankrupt the next day on the 15th, on September 15th. So they delayed things about 2 weeks longer than expected. And Forever 21, they're focusing now on online sales. This is a trend that, while it's going to be good for consumers, they're going to get more deals with online sales, and retailers can cut their costs. So that's beneficial to consumers. However, a lot of people are expecting, a lot of people did have retail jobs. And if you go back, and I did a show on this only a couple weeks ago, I'll put the show, which was Jerome Powell's Lying, More Proof That the U.S. Will Have an Official Recession Very Soon. This show was done on September 13th, and I put 3 main reasons that retail was having immense problems, and that's where a lot of jobs were created. The shale oil boom was in trouble. There was a lot of CapEx cuts. And if you go back and look at the Bureau of Labor Statistics, the jobs that have been created since 2008, a lot of them, besides in healthcare and all that healthcare misallocation of capital and healthcare fraud, even though there's more jobs in healthcare, the costs for healthcare are rising out of control. But the other main sources of supposed new job creation in the U.S., in the U.S. economy, has been restaurants, bricks and mortar retail, and then the shale oil boom, which was mainly out of North Dakota, Texas, and a few other states. The increase in jobs in North Dakota was enormously large, particularly from 2008 to 2015. I think it was almost 30% increase in their jobs there. And that's just, that was the direct jobs were the oil jobs, and then you had, with the multiplier effect there, all the service sector jobs of restaurants and shops surrounding there. But in general, restaurants and retail are not high-paying full-time jobs. They are full-time jobs, but a lot of these companies, they do minimum wage, or sometimes it's like $2, depending upon which state you live in. I know California is trying to put minimum wage, so that means more automation, but there's going to be, in a lot of states, when I was a server for my college jobs, it was like $2.13 an hour plus tips. I'm not sure what it is now. That was quite a bit a while ago. But there is an acceleration of retail going away, and while that is good for consumers, it's bad for a lot of low-skilled labor, humans, who want jobs. So that's the trade-off there. So Forever 21 is now bankrupt. They're going through Chapter 11 bankruptcy. So an American mall mainstay that helped proliferate the quote-unquote fast fashion trend has filed for bankruptcy as of last night. The company wrote in a letter to its customers on Sunday that Forever 21 had voluntarily applied for bankruptcy as part of a Chapter 11 filing. The company said the measure allowed it to operate business as usual while taking steps to restructure the business. The California-based retailer stressed that the filing did not indicate plans to go out of business, but they are closing a lot of stores. A representative for the company told Business Insider in a statement that the company planned to close most of its locations in Asia and Europe, but to continue operations in the U.S., Mexico, and Latin America. And let's see here, they will soon cease operations in 40 countries. The company also plans to close up to 178 stores in the U.S. and up to 350 globally. It's just sad. There's a lot of human beings that are going to lose their jobs and are going to have to either retrain or try to find another job. So that means less people consuming, more people on unemployment, more people with less discretionary income, more people blowing through their savings if they have them. Just really sad all around. The Wall Street Journal recently also ran another story called Eyeing That Sweater, It's Yours in 4 Easy Payments. This was from a couple days ago, actually yesterday, by Anna Maria Andriotis and Peter Rudiger. And it follows people here in the United States who are now increasingly using payment plans or installment plans to buy expensive sneakers, makeup, and also clothes. So showing that some of these people have so much credit card debt that they're now buying things on installments. And there's other stories as well that have come out in the last couple weeks about consumer stress. Zero Hedge has been covering a lot of this, whether it's a senior market analyst at Reuters, John Kemp, that Zero Hedge ran the story on Saturday, September 14th. U.S. consumers at maximum leverage might not be able to save the day. So senior market analyst of commodities at Reuters says in a new report that U.S. borrowers as a whole look stable, but there are signs emerging that point to a trouble, especially in the farm sector, as a result of the trade war and among a robust jobs market and some wage growth, consumers are nearing maximum leverage. This analyst first talks about the positives in the lending market. He notes the number of commercial bank loans and leases 30 days or more past due in the second quarter 2019 is at 1985 lows. The percentage of all bank loans and leases in arrears was only 1.5% last quarter, down from 1.64% over the same period in 2018. The high was at 7.4% in March of 2010 after the previous recession. But the analyst notes other signs of stress are building that could produce spillovers. The trade war and then also the default rate on agricultural loans jumped to 1.82% last quarter from a low of 0.77% in 2015, so that's more than double. Besides the farmers, another concerning trend is a jump in delinquency rates for credit cards and other consumer loans, which have been above trend since 2015. Consumer delinquencies are at several decade lows thanks to a robust jobs market and some wage growth, but the current state of the consumer, this analyst says, may not have the capacity to take on much more debt without running into trouble. Plus, you add in the real world of stagflate and tax and lie. For those of you who are wondering why I'm talking about bricks and mortars retailer and the consumer, the GDP here in the United States is made up of around 70% consumer spending. So if the consumer gets sick, if they cut back on discretionary spending, the real economy, the GDP numbers would by default start to drastically fall. So that's why it's important to monitor consumer sentiment and also what the bricks and mortars retailers are. So yes, bricks and mortars retailers, they've shut down over 8,000 store locations already so far this year. It's on pace for a record pace. A Goldman Sachs analyst, I'm going to switch articles for a second. A Goldman Sachs analyst was saying in another report that they're expecting, I think, over 12,000, which would be another record. So we're already at a record pace so far this year. We're at a record number, and now people are expecting 12,000 total retail bricks and mortar retail store closures by the end of this year. So let me look up. Okay, here we go. So Goldman Sachs says their real estate investment trust team, which monitors the shopping malls, does not expect a near-term reversal of store closures from retail tenants, which should continue to result in e-commerce share gains in their view, and that the trend is just going to continue into next year as well. So there are already, according to this research, there are already 11,000 store closures this year, exceeding the annual number of the past several years, according to Coresight Research, which projects the retail store closure number to reach 12,000 by year end. And so they think that e-commerce growth will likely accelerate over the course of the second half of this year as a record number of retail store closures, initiatives around fulfillment such as Amazon's $800 million investment in same-day delivery and Etsy's move to free shipping. What we're also seeing, though, guys, and this is very unusual, another red flag, I've actually never seen this, is that Nordstrom's, their New York City local stores, are now accepting Macy's and Kohl's returns. Very weird. So I think this is out of desperation to try to gain any market share, to try to gain any type of sales at all. Nordstrom's is now, this was announced earlier this month in September, on September 9th. So Nordstrom's is going to take returns from Macy's and Kohl's. Doesn't make a lot of sense to me in terms of actually making money. It only makes sense that Nordstrom's is trying to take market share as they expect the bear market. So they're trying to get any customers at all. Crazy stuff. Okay, so back to the consumer spending article. So commercial banks have charged off almost 4%, so 3.74% of all credit card loans the last quarter. So in the second quarter of 2019, the growth rate of bad loan write-downs, the growth rate of bad loans write-downs was at the fastest pace since 2012. So the most important takeaway from this analyst report, and I'll put the link in the information and description section if you want to read the article more, are consumers are at or near maximum leverage according to the research this guy is doing, making the narrative that consumers will save the day a little hard to believe. This other story, which just came out 2 days ago from Zero Hedge, also adds to that the consumers are starting to feel even more stress. So a lot of people, the major areas in the real U.S. economy, where there was job growth. So the shale boom, there's big capex cuts in the shale boom. And when there's big capex cuts, which is maintenance capital or capex, when there's capex cuts, that means a lot of job losses. And then that means if their oil workers don't have jobs, that means they're not spending money at restaurants, at shops, at bars, online. They're not spending as much. So the service sector jobs around the oil fields, those are going to feel the pain with the capex cuts. So people will either have to take pay cuts in the oil jobs, oil service area, or they will be losing their jobs shortly with the announcements of the capex cuts. And then also the bricks and mortar retailers are closing stores. That means a lot of people are losing their jobs, and they didn't have what the government would view as full-time jobs, because you have to have 40 hours. So a lot of companies, whether it's Target or Walmart or others, have very sophisticated software, employee management software that managers use to make sure that no one working there works more than 39 hours. So everyone's hours are juggled. So they only work 39 hours, so they don't get full benefits, so they don't get health insurance covered. It's a mess, but it is what it is for now. So a lot of people, I guess, are just happy to have a job. It's truly tragic what's going on right now. But e-commerce is benefiting from all this. But a lot of human beings are not being hired for e-commerce jobs. That's the problem. So you have the consumer who's benefiting on one hand, and on the other hand, human beings who are lower skilled labor, or maybe they just got fired from a higher paying job, or they're just out of college, or it's a college kid trying to get a part-time job, and the jobs that used to be there are not going to be there now, especially in retail. It's looking bad. Maybe they changed the laws, but I was under the assumption of the last time I looked at it was 40 hours. That it was 40 hours to be considered a full-time employee to get all your healthcare benefits and things. So maybe they changed that. I was under the assumption the laws were still 40 hours. So these things are starting to, there's trade-offs here. More stores switching to e-commerce and online, and Forever 21 is maintaining its online sales. So consumers will get more sales, they will get free shipping, they will get other benefits, but human beings who were working there, and there's a very big Forever 21 here in the Washington, D.C. metro area. I think it takes up an entire block. It's an enormous store. I've driven by it a couple times in the last month or two. It's like a couple blocks from the Capital One Arena, so where the Washington Capitals play. So it's downtown there. There's a pizza place my best friend and I like to eat once in a while. We drive downtown. But it's an enormous building. I wonder if they're closing that one down. I didn't see any signs on it. I was there actually 2 days ago, so I didn't see any signs on it. It looked fine. But we'll see if they close that one down. It's just sad. There's a lot of people that are going to lose their jobs. So just really, really bad news for retail. Retail is going through an extremely painful restructuring right now. My friend, hedge fund manager Tavi Costa, he's definitely a follow on Twitter. He's a very good follow, really good charts and analysis. And he just put out a chart in the last couple days about Amazon stock. And Amazon stock has just broken its 4-year trend line. So Amazon's starting to break down. It hasn't crashed, but it's close to looking like it's going to crash. And I have the chart up here. Again, this is not financial advice, just my opinion. I have the chart up here of the Spider S&P Retail ETF, which is XRT Xavier Raphael Thomas. And that chart started to look really ugly towards the end of July. It crashed from 43 down to 37, and then it's rebounded, and it's starting to look extremely volatile. So it's starting to factor in all this other news. It's starting to factor in all this retail store news. Okay, excellent question here in the super chat from Kenneth. What will fill these store locations? The answer is probably not much for a while. These store locations will remain empty, which will put even more pressure on the owners of the buildings, the commercial property owners who are holding them on leases. And the commercial property owners are feeling stress, and they're trying to charge higher leases, even though it's not really justified, because they're holding it with debt. So here in the Washington, D.C. metro area, I can just give you a lot of anecdotes. There's really nice shopping areas in Georgetown. And Georgetown is there's new buildings and also a lot of old buildings, a lot of culture in Georgetown area. And there's a lot of people, especially tourists during the summertime when it's warmer here, who are walking around Georgetown, and a lot of people are willing to shop from out of the area. And there's just tons and tons of empty buildings there was an entire mall that was mostly empty around Georgetown and Wisconsin and M Street, which is a really busy area, and there's a ton of empty shops there too. So I think these locations, a lot of them are going to remain empty for a while. And the Wall Street Journal, I think, did a story on this in the last few months, and they were talking about how Amazon is buying up a lot of these empty shopping malls, and they're using them for fulfillment areas. I think they're putting warehouses or fulfillment areas in there. There's a couple key retail stocks to watch. So, not financial advice, just my opinion. I would watch Amazon shares and Lululemon. And if those charts start to break down, things are going to get very ugly very quickly for retail. Because Lululemon's been probably the top performing stock since one of the top 5 performing stocks out of all the stocks since 2009. I think it's up over 600%. It's up an insane amount. And Amazon stock has started to breach its 4-year upward trend line. So take a look at that chart that Tavi Costa has on his Twitter from a couple days ago. So there's just a lot of evidence that the real economy in the US is starting to get worse, and the consumer is really starting to feel it. This other article, finally, I'm going to keep the show short, and I'll just put the links for the information and description section in there for the other articles if you want to go more in depth on this. But consumer stress, defaults rise to highest level in 2019. So one of the loudest narratives heading into the fall by the mainstream financial press is that a healthy consumer is propping up the U.S. economy. Consumer spending at retailers, bars, and restaurants has slowed, but nothing to warn about yet, powered by record high credit card spending. And the credit card spending last year started to really increase a lot. Started to increase, I think, by over $800 billion. Americans are nearing the point of maximum leverage, which could be an ominous sign that good times are nearing an end. The Trump administration continuing to promote the greatest economy ever narrative to tens of millions of Americans ahead of a downturn is probably one of the most irresponsible things that a government can do. Artificial optimism has allowed consumers to rack up more debt than 2008, and it's a ticking time bomb that could shock millions since they haven't planned for a recession. So people have lots of credit card, auto loan, other types of debt. There's other show I may do about how the banks are trying to extend the housing bubble. So just a lot of craziness. The Forever 21 is a microcosm to all this. Amazon has made a profit. They just don't make a lot of profits. There's a lot of shadiness in Amazon's accounting, but no one seems to really care. There's very few people that actually care. Amazon spends over $10 billion, I think, per year on research and development, they claim. So Kenneth, I don't think anything's going to fill a lot of these store locations. The problem is these commercial property owners are holding these on mortgages and debt, and they're trying to raise the leases. So I know locally around here in the DC metro area, there's a lot of restaurant owners that the commercial property owners are trying to raise the leases on, and they can't afford it. So it's looking bad there too. There's been a bunch of good restaurants that have been here a long time in the Ballston, Clarendon area. Some of them that were here for 80 or 100 years, and those have gone out of business recently. It's really sad. So some of these old buildings are being demolished, and they're jacking up the rent, even though I don't think it's justified. But these commercial property companies are in big trouble. Not financial advice, just my opinion, but some of these real estate investment trusts are in big trouble, because they're going to have to try to protect themselves, raise the leases, because they're holding these properties on so much debt, and their tenants, the restaurants and retail, can't afford the rent increases. So this is another ticking time bomb. Danielle DiMartino Booth has been talking about a commercial property bubble for a long time, and I see it all over the DC metro area. It's very evident in a lot of these restaurants and retail that they just cannot afford